Good morning, students. Welcome back. So today we'll continue with our discussion on employee benefits, and we also plan to start with the other accounting standard, most likely to. Yeah. But before we really get on to this discussion, some of the concepts on accounting standard further, let's do a quick recap. Okay. Further, I also understand that instead of just writing your points, your comments, your questions in the chat box, you are also given this audio mode, so you can also feel free. Yeah, so more of questions that you speak, that will give more clarity to the other students as well. So I would appreciate if you have any questions, if you have any doubts, yeah, so just speak up. Okay, yeah. So let's do a quick recap. So in terms of employee benefits, so far, a couple of things we have discussed. One is about the short-term benefits, right? In terms of short-term benefits, when it comes to short-term, so we can say short-term is more of about the employee benefits, which are going to be settled within a period of next 12 months. Okay, so that's the understanding that we have. Further, in relation to short-term benefits, we discussed that these are required to be accounted for, and any accrual that you have, that is what you record. Moving further, next was about the post-employment employee benefits. Now this was important, and in terms of its accounting category, we discussed that this is required to be categorized into two parts. So can you just help me understand what are those two categories when it comes to post-employment employee benefits, and what are their accounting requirements? Over to you quickly. So when it comes to post-employment benefits, what are the two categories? Yes, quickly. Okay, great. Charandeep says defined contribution plan. Deepika is also saying defined contribution plan and defined benefit plan. Great. Now, can you help me understand what is this defined contribution plan? Charandeep, if you can just explain this. Yeah, you need to speak up. What is this defined contribution plan? What is the understanding of defined contribution plan, and how is this required to be recorded? Over to you. Yes, Charandeep, I'm just waiting for a response. If you want, you can just raise hand. You need to speak up quickly. You're there. Yes, Charandeep. What is a defined contribution plan? Okay, anyone else who can explain what is this defined contribution plan and how is this required to be recorded? What is your understanding of defined contribution plan? So Charandeep is writing. Charandeep, you need to speak up. Yeah. Okay, so he's saying that company is liable for regular contribution only. All right. How is this required to be accounted for? Yes. Can somebody explain? How do you record this? How this is required to be accounted for? When it comes to a defined contribution plan, what is the accounting requirement? Okay, then I think she's saying you record the contribution as an expense in the P&L. Very good. Now, moving on to the next item, that is about defined benefit plan. Now, as around defined benefit plans, there are a lot of components that we discussed. Okay, quickly, the first one. Can you help me understand when it comes to a defined benefit plan? Okay, so in terms of defined benefit plan, how's this defined? Number one, what is the understanding of defined benefit plan? And how is this required to be accounted for? Great. So Deepika is saying PF fund is an example for this. Yes, but PF fund we discussed can also be an example for the defined contribution plan. So now, as around defined benefit plan, what do you understand about it? And of course, how do you record this? Okay, then she's saying in case of defined benefit plan, you will have this defined benefit obligation from which any planned assets which are there, those are required to be reduced. And on a net basis, you record this in the balance sheet. All right, great. Now, in terms of defined benefit plan, can you tell me what are the components which will go to P&L? In terms of defined contribution plan, what are the components that go to P&L? Soumya, can you please explain this? Soumya, if you can just speak up. What are the components in case of a defined benefit plan that will go to P&L? Over to you. Yes, Soumya, I'm waiting for a response. Whether it goes to P&L, and if at all it goes to P&L, what are those components? Quickly. So I can see you are responding through messages, but you are not speaking up. See, it's important you speak up. Charandeep is saying service cost and the interest. Okay, so these are two, but we understand there were three components. So what's the third component? Kirti is saying current service cost and interest. So there was also a third component which goes to P&L. Can you tell me the third component? Very good. So she is saying it's actuarial gain and loss. Yeah. Then I think same is the response from Soumya also. Very good. All right. So now, in terms of some of these components which go to balance sheet or the P&L, we also discussed that this is required to be accounted for using projected unit credit method. And in case of projected unit credit method, we engage an expert. Can you please name that expert? What do you call that expert as? Who's required to be involved in that valuation exercise? Very good. So it's the actuary. So that's what Charandeep says. Yeah, Soumya is also saying it's the actuary. Yeah, so actuary will do this valuation, and basis that valuation, you are then required to account for this. Okay. So then I think we looked at a few questions around it. And of course, we are going to pick up some more questions today. Yeah. But I also asked you if you can just practice some of the questions. So did you try that? Quickly, please confirm. Okay, so a couple of questions. Who has tried that, and whether you have been able to solve that or not? Please confirm quickly. Yes, somebody tried that or not? Quickly, over to you. So did you try this? Okay, so Devu tried this. Devu, you have been able to solve this? And what about others? Yeah, any questions if you have as around some of these questions? Okay, so of course we are going to cover this, but if you have tried this, if you have not been able to solve this, or maybe if you solved this, but your response was not the correct one, your solution was not the correct one, so you'll get a understanding as to where you may have gone wrong. So Devu has solved this. Very good. All right, so now let's look at this question. Rockstar Limited discontinues a business segment. Under the agreement with the employees union, employees of the discontinued segment will earn no further benefit. So what has happened? There was a unit of the entity which has been discontinued. Okay, so the employees which were working in that unit, they will not be continuing. So that's why they will not be paid for that. So this is a curtailment. So what do you call it as? Curtailment. And in this case, the curtailment, or you can say the employees who will not be working anymore, they are not paid any further amount. Generally, when the curtailment will take place, so employees will be paid some compensation. But this is a curtailment without settlement because the employees will continue to receive benefits for the services rendered before the discontinuance of the business. Okay, then curtailment reduces the gross obligation for various reasons, including the change in actuarial assumptions made before curtailment. If the benefits are determined based on the last pay drawn by the employees, the gross obligation reduces after the curtailment because the last pay earlier assumed is no longer valid. Rockstar Limited estimates that share of unamortized service cost that relates to the part of the obligation at rupees 18. Okay, so there's an obligation which has been considered. So you are required to calculate the gain from this curtailment and the liability after curtailment to be recognized in the balance sheet. And of course, in the P&L, any gain which is there on the basis of the following information. So what is that? Immediately before the curtailment, gross obligation is estimated at 6,000 on the basis of actuarial assumptions. Then, in relation to this gross obligation, plan asset was 5,100. Okay. Unamortized past service cost is 180. Curtailment reduces the obligation by P600, which is 10% of gross obligation. Okay, so now let's try to understand what is this curtailment, what is this unamortized past service cost, okay, what is this gross obligation. All of these points we'll just try to understand with the help of this example. Yeah. Okay, so I'll just take you to the solution, and while solving that, we'll just try to look into all of these aspects and also around this concept. Now, in this case, question has specified there is a reduction in gross obligation. What is that? 600. Correct? Yeah. Now, this is a reduction in the gross obligation. So initially, when we started off, what was the gross obligation, total gross obligation? Tell me quickly. What was the total gross obligation? Over to you quickly. What was the total gross obligation? It was 6,000. Yes. Now, from this total gross obligation, or you can say the gross obligation, there is some reduction. So now it's reduced by 600. So is that reduction again? Now, what is this obligation? Tell me. Obligation is a liability. Yes or no? Obligation is a liability. Over to you quickly. Obligation is a liability on the part of this company Rockstar Limited. Correct? So if let's suppose liability will go down by any number, so will that be a gain to the company? Yes or no? Will that be a gain to the company? Yes or no? Yes? Great. Devu, Ishan, they are saying yes. Somay is also saying. Very good. Now, in relation to this gain, yeah, so there is some past service cost. Okay, so now there is some past service cost. Now, what is this past service cost? So we are given that Rockstar has estimated share of unamortized service cost that relates to part of the obligation is 180. Okay, I'm talking about the gross amount. That's 180. Okay, and in relation to the obligation which is curtailed, again the proportion is what, 10%. Yeah, so this past service cost will also be reduced from this. Yeah, so it becomes 582. So if you reduce this, 582 is the total gain from the curtailment. Now, this gain is what? This gain has arisen to the company because some of the employees will not be continuing. Why? Because this business segment is discontinued. Okay. So now in terms of the gain, what is the amount that we have? 582. Okay. Now, moving further. If you look at the liability to be recognized, So we understand liability is already reduced by 10%. Liability is reduced by 10%. Correct. Now, after reduction of 10% liability, we are left with 5,400. Now, from the liability, do we reduce plan asset or not to be presented in the balance sheet? Tell me, from the liability, do we reduce the plan asset? Over to you quickly. Do we reduce the plan asset? Yes or no? Deepika says yes. Chirandeep is also saying yes. Yeah. So that's what you do. Yeah. So we record it on a net basis. Correct. So therefore, what will happen? If you reduce the plan asset, so what is the amount of plan asset? Is that given in the question? Yes. So the question says fair value of the plan asset is 5,100. Yeah. So liability is reduced, but the plan asset is full. So what do you have? 300. So this reduced liability after netting of plan asset is what? 300. Okay. So 300 is the amount of plan asset that we have. Right. Then, as against this net liability of 300, there is also a portion of unamortized past service cost. See, a portion of past service cost has already been adjusted. Okay, or you can say that has gone away. But 90% of that still remains. 90% of that still remains. So that will also be adjusted from this liability. Right? So therefore, this liability which is pending to be recognized in the balance sheet will be what amount? 138. Okay, so that's 138. Right? Okay. Now, the question arises, what is this unamortized past service cost? So you can say a liability has been recorded and corresponding to this liability, expense was not debited. So what did you do? You recorded prepaid expense. So in such a case, what will happen? Against liability, you will have an asset. So this asset also needs to be amortized over the period. Because this is unamortized, so that's why you also present the liability net of this sort of unamortized cost. So that's why liability which will be presented in the balance sheet will be what? 138. Okay. So in the given question, if you look at the liability after this curtailment, so what is going to be that amount? 138. And if you look at the P&L, what is going to be the P&L portion? It's a gain. Yeah. But why did this gain take place? Because some of the employees have been discontinued. So the company would have recorded their liability. Yes or no? So this liability which is recorded is in respect of, let's suppose, 100 employees. Okay, if 10 employees will not be paid this amount, so what will happen? That will be a gain to the company. So that gain is nothing but this gain from curtailment, which is amounting to 582. Okay, clear on this? Everyone, quickly, please confirm. If you have any questions, please raise hands and ask your query. Over to you. If you have any questions, please raise hands and ask your query. I'm just waiting. Okay, so then I think I have this query coming from Ishan. Yes, Ishan, please pick up. Yes, Ishan.
Sir, if in this question there was no curtailment, then we
Right,
would have we would have reduced the whole unamortized cost from the liability only, no?
correct. So in that case, there would not be any gain from curtailment. That's one. So the only thing will be the balance sheet item, because as regards the P&L, we do not know what changes have taken place during the year. So in terms of the balance sheet, you'll have three items. One is this gross obligation, second is plan asset, and third is this unamortized service cost. Okay. So from the gross obligation, you'll reduce both the components, plan asset as well as unamortized service cost. Okay. And you can also say that this is something which the company would have already been presenting in their balance sheet before the curtailment. Company was always doing that. Now, because the curtailment has taken place, so that's why company wants to check now how the balance sheet is going to change. Okay. All right. Any more questions?
No, sir.
Okay. Anyone else? Anyone else? Quickly. Okay, so I can see this query coming from name is missing. So I would request you to please explain your query. You speak up, you explain your query so that everybody can understand. Yeah, so your name is not around. Yes, please pick up. Yes, please go ahead. Yes,
Hello, sir.
yes.
Sir, it is past service cost, right? So past means it is a liability for us. So is it in like it is like outstanding liability, right, sir? But why are we treating as prepaid expense?
See, there are two components to it. It is unamortized past service cost. Okay. So now what is unamortized? Let's suppose, say the employee has rendered some services. So of course, as you rightly mentioned, company will have a liability. So will the company record a liability for this? Yes, that has been recorded. And that is appearing in the gross obligation, or you can say the obligation. Corresponding to that, due to the accounting requirement, this has not been debited. This has been kept as unamortized, means over the period this will be amortized. So you can say this required deferment of cost. This is required to be amortized over the period. Okay, so that's why it was appearing under the asset side. So against the liability, you did not have an expense. Yeah, the equivalent expense. So that's why from the gross liability, you reduce this. So your point is correct that these services, if any, if those have been rendered in the past, so they would only be appearing in the liability. But corresponding to that, there will be an expense which will go to P&L. Okay. So this is not that amount which has gone to P&L. This is the portion which has gone to unamortized part. Okay, which was appearing on the asset side in the balance sheet, and that's why you are netting it off.
Sir, but why is it in the asset side? It should be in the liability side, no, sir, because it is in relation to past services.
Okay, let me just explain this to you. So just a minute.
Yes.
I'll just take this
Yes.
file. Let me just share one file with you. Okay. Now let's suppose we have this period of 5 years. Okay. Now let's suppose employees rendering some services. Okay. But in respect of those services, the cost which is required to be incurred by the company will have to be deferred over a period of 5 years. One, two, three, 4, 5. Yeah, okay. Now,
Yes.
in this particular year, employee is working. And of course, he will also be working in the next few years. In all of these years, he is expected to be working for the company. Yeah. So basis that, what did the company do? Company expected a liability which is going to arise on its part for the next 5 years. Let's suppose that amount was rupees 100. So this 100 will be a liability for the company. Yes or no?
Yes, sir.
So this will be a liability on the part of the company. Now corresponding to this liability, now two options are available. Either this entire amount is taken to P&L. Okay, so what is the accounting entry you'll pass? Tell me. Expense debit to liability. That's the accounting entry you'll pass in such a case. Yes or no?
But our live
Yes or no?
But a
So
liability will reduce, right? So liability should be debited.
no. So I'm not saying that liability will be reduced. I'm saying to begin with, when you had this understanding with the employee, so what did the company do? Company estimated that for the next 5 years, company will have to pay an amount of rupees 100. Okay, so that's the expectation of the company. Yeah, so that's the arrangement.
Yes.
So now, if this liability has to be recorded, I'm not saying reduction in the liability. So we have just started off. I'm just taking you to the concept. Okay, forget about unamortized service cost in this case.
Okay.
So the point is that this liability which the company is having or which the company plans to record, how will the company record it? There are two ways. So company should pass an accounting entry, expense debit to liability,
To liability. Yes, sir.
100 and 100. So this is what the company should do. Okay.
Yes.
But what if this entire amount cannot be recorded as an expense in first year? What if this expense is required to be recorded over a period of 5 years? So what will you do in such a case? So you'll
Sir, he
not
will.
record it as expense.
Mm.
So you'll say unamortized service cost debit 100 to liability. Yes or no? So this is what you will do,
Yes, sir. Yes.
correct? Now, in this case, you have recorded this entire liability, but you have not recorded your proportionate expense year on year. So how will you record this
Okay.
proportionate expense year on year? Every year you will be amortizing this. Okay.
Yes.
Now,
P&L
is it a
account debit to the service cost.
yes? Very good. So that's what you will do year on year, or every year you will be doing this thing. Okay. Now, let's suppose you are required to present this portion in the balance sheet.
Mm.
Okay. So what will you do? In the balance sheet, you will have one portion of asset in a
Yes.
way, yeah, and one portion
Yes.
of liability. Okay. So if let's suppose these two happen to be the same amount, so what will happen? This will become zero.
Yes.
Okay. But if let's suppose this liability changes over the period, why? Because liability will have to be computed using certain parameters, which is required to be computed by the actuary. Actuary will take a lot of assumptions, okay, which will not only have the component of, say, past service cost, but also the current service cost. Okay, some more assumptions are taken, present value is also computed. So over the period of time, what will happen? This liability amount may not match with this unamortized portion, correct? There are a lot of factors because of which this liability portion will keep changing.
Yes. Yes, sir.
But when it comes to this asset, okay, or you can say sort of asset that you have, this unamortized portion, this you will amortized in an equalized manner over the period. So if let's suppose that's required to be amortized in an equalized manner, so what will you do? Every year you'll say, I'll record 20. So that's what you'll do every year.
Yes, sir.
Yes or no? Yeah. So that's where these amounts may change over the period. Okay. So in the given situation, now let me just take you back to the given situation. So what has happened in the given situation? In the given situation, at this point of time, company may have recorded some liability. Okay. But starting from this date, the business for which the company had estimated certain liability, that business is now discontinued. Now, if the business is discontinued, then the expectation which the company would be having for future. Remember, in the previous session that we discussed, we talked about a future liability. So this obligation that you record, this obligation is not for the today's date. This is for the future date. Let's suppose after 20 years, this obligation is expected to be paid. So what will the actuary do? Actuary will pick up a lot of assumptions. Actuary may be thinking that some of the employees will retire, if let's suppose all the employees continue, so actually we'll think that over the period they will get increment. So we need to incorporate that portion of increment also. Yeah. So using a lot of assumptions actually will compute the liability, which is nothing but the future value. Correct?
Yes.
And when you record this, so you record it while computing its present value.
Present value.
So in a way, when you record a liability today, you are recording the liability which is full of these assumptions. Now, how are these assumptions relevant? These are relevant because an employee is expected to continue for next 20 years. But if let's suppose suddenly you have this change that today that employee is no longer continuing with the company. Why? Because maybe the business is not there. So what will happen? All of these assumptions, all of these things will
Change.
just get away.
Yes.
Correct? And
Yes.
because of this, company is expecting that the liability will go down. And that's
Yes.
where company is expecting they will have some benefit. And in relation to in the past, the portion which they had not amortized. Why? Because that was required to be amortized over the period. Some portion of that will also go away along with that. Why? Because that may not be payable anymore or that is not required to be recorded. We don't understand the nature. So I'm just trying to explain the concept. Clear on this now?
Yes, sir. Yes, sir.
Very good. All right.
Thank you, sir.
Sure. Any more questions? You can see a few messages coming up. Any more questions if you have? Yes. Anyone else? Any more questions? Deepika is asking, amortized past service means, yes, that's correct. Then I can see, yes, Deepika, that's correct. Huh? Okay, so Ishan has a query. He is asking, sir, if we are paying back the liability every year along with the expenses on liability, so we'll record the liability at the reduced value of the liability on the date of recognition of curtailment. Yes, that's correct. And because you'll reduce the liability, so that's why you are getting a gain. Okay. Yeah, that's primarily the reason why you are getting that gain. Clear, Ishan? Okay, very good. All right. So now let's move further. Okay, so we will pick up this next question. Okay, so Nidhi has some question. Nidhi, please go ahead with your question. What is your question? Nidhi, please pick up. What's your question? Nidhi, I'm waiting for you. Quickly, what's your question? Nidhi, you're there? Okay, so please pick up. Huh? So you're saying illustration 8, may I have a question, but you're not speaking up. So I'm waiting for you to speak. So you can just put on your audio, ask the query huh? Quickly. So what is your question? Yes, Nidhi, please pick up. Yes, Nidhi, please ask your query. Please go ahead.
Good morning, sir.
Good morning.
सर इलस्ट्रेशन 8 में जो लास्ट में लेस अमोर्टाइज पास सर्विस कॉस्ट 180 का 90% आया है वो क्लियर कर दीजिए.
Okay, so why that has been taken? Okay, right.
जी
So
सर.
let's continue on the discussion that we just had on the example which I picked up. Okay, so now why that 180 into 90% has been taken. Okay, so that's your point.
जी सर.
So now when the liability is recorded, so your liability gross amount was what, Nidhi? Tell me.
So gross amount 6,000.
6,000. Okay, but you understand out of 6,000, 600 will not be payable anymore. Correct? So 10% is gone.
Yes.
So therefore you have
Yes.
reduced 10% of 6,000. So therefore now the liability that will be payable will be equivalent to 5,400.
5,000.
Correct? Now,
Yes.
corresponding to this liability, there were two portions which were appearing on the asset side. One, that was plan asset. So do you reduce the plan asset from the liability while presenting in the balance sheet? Tell me, do you do that?
Yes.
So how do you present liability? Net of assets? That's the requirement.
Yes.
Remember DBO? Okay, so this liability is nothing but the DBO, defined benefit obligation. Correct? Now from
Yes.
this liability, what is the amount of your plan asset that you will reduce?
Sir, 180.
Is that given in the question, plan asset? Is the plan asset given in the question? Tell me, Nidhi.
Sir, 5,100.
Yes. So that you will reduce. Okay. Further, you understand there is some unamortized portion which is also
Yes, sir.
appearing on the asset side. Now this unamortized portion is what? 180. Correct? But out of this
Yes, sir.
180, similar to the liability, 10% is not adjustable anymore. So you'll reduce that
Yes, sir.
10%. So what is going to
Yes,
be
sir.
your amount?
18.
So this will be 162.
Yes, sir.
162. Yeah. So this is what has been done. Okay. So that's why the net liability that you present will be what? 138. Now clear on this?
Yes, sir.
All right. Great.
Thank you, sir.
Sure. Any more questions? Anyone else? Okay. So Pawan is asking, 600 कहाँ से आया है sir? See, 600 is given in the question. Okay, in fact, if you would have just looked at Pawan, the computation we just did. Okay, so the question says that 10% of the obligation. Pawan, if you look at the question, it says 10% of the obligation. Okay, that's been curtailed. Yeah, so it's given in the question. If you read D point, that's where it has come from. Clear? Clear, Pawan? Ishan is asking, sir, the planned asset could be any fund created or it can be anything other. See, plan asset, you can say, is a kind of investment which the company has done. And again, it could be any type of fund. It could be any type of investment. So that's how you need to look into. Yeah. Okay. Any more questions? Everyone clear on this? Yes, everyone clear? Yeah. All right, great. So now let's pick up the next one. Huh? Okay, so let's pick up the next one. Okay, so moving on to next one. An employee, Roshan, has joined the company XYZ Limited in the year 2000 X1. Annual emoluments of Roshan as decided is 14,90,210. Okay. Emolument means compensation, or you can say the amount which is payable to him. Okay, that is also about the salary, right? Nidhi is asking, sir, in Hindi, meaning of curtailment, you can say chhod diya. that portion is like जैसे बोलते हैं ना कि अब ये यहाँ पे इतना कटौती कर दी है, इतना अमाउंट अब पे नहीं होगा. That's the meaning. Clear? Nidhi, clear on this? Yes, quickly. Nidhi, are you clear on this? Very good. Okay, so let's move on to this next illustration now, Nidhi. Huh? An employee Roshan joined a company in X1, it's XYZ Limited. Annual emoluments of Roshan as decided is 14,90,210. Company also has a policy of giving lump sum of 25% of the last drawn annual salary of the employee for each completed year of service if the employee retires after completing a minimum 5 years of service. Okay, so there's one portion of this fixed amount that the employee will get. Okay, further, in addition to this, he will also be getting some more amount, lump sum payment he will receive. But when will this lump sum payment be payable? Can you tell me? When is this lump sum payable? Quickly, over to you. When is this lump sum amount payable by the employee? Tell me quickly, everyone. When is this lump sum amount payable? Very good. After retirement. Ron is saying after 5 years, which is fine. But this will be paid to him after retirement. Okay. For this, he needs to complete. So that's the eligibility criteria. Right? Salary of Roshan is expected to grow at 10% per annum. So that's the percentage increment. Okay, so every year he is expected to get increment of 10%. Company has inducted Roshan in the beginning of the year. So you may be thinking in which year he has joined. Okay, for the purposes of your calculation. So they have kept it simple. So he has joined at the beginning of the year. And it is expected that he will complete minimum 5-year term before retiring. Okay, so therefore it is expected that he will get increment for 5 years. Of course, he will get this lump sum payment, that's expected, but he will also be getting increment each year, right? Now, what is the amount of what is the amount the company should charge in its P&L every year as the cost for defined benefit obligation? Question number 1. Now, what does it mean? It means corresponding to this lump sum payment, corresponding to post-employment retirement benefit, post-employment benefit which the employee is going to get. What is going to be the P&L charge which the company will have to record each year? Okay. Also calculate current service cost, interest cost to be charged each year, assuming a discount rate of 8%. Now, in this question, there are two amounts which are given to us, or you can say there are two types of payments which the employee is going to get. So it's a question for everyone, and you need to answer this. One is this fixed amount 14,90,210, and second is this lump sum payment. So can you tell me that when the defined benefit obligation will be computed? Yeah. So which portion or which types of payments out of these two you'll call as post-employment benefit? Or will you call both of them as post-employment benefit? Over to you. Which one will you call as post-employment benefit? Over to you quickly. Yes. Great. I think Soumya is saying the one that you know. So I think that's the previous response. Okay. So she is answering only the lump sum payment. Ishan is saying 14,90,000 will be the one. Harshada says 25% which you pay on retirement will be post-employment. Great. Nidhi is saying lump sum payment. Devu is saying this lump sum one. Rohan is saying lump sum one. Very good. Divya has the same answer, lump sum one. Very good. See, in this case, this 14,90,210, it's not a post-employment benefit. Yes or no? What is the post-employment benefit? The one which is payable post-retirement. Correct? So 14,90,000, is that payable to the employee after retirement? Tell me. 14,90,000, is that payable after retirement? No. So will it become post-retirement? No. But yes, for computing the post-retirement, this 14,90,000 will have to be used for calculation purposes. Okay. So when you will calculate the post-retirement benefit, so you will use some basis. And what is going to be that basis? This 14,90,000. Everyone clear on this? Yeah. All right. So now let's look at the solution. Okay. So now after 5 years, question says this benefit will be payable on the basis of last drawn salary. So after 5 years, what is going to be the last drawn salary? We need to compute that. Nidhi is asking why PF factor has been given. I'll come to that point. Okay. So let me just get done with all of these things. You will get to know about it. Last drawn salary, okay, which is given. Last drawn salary which you'll have to use for calculation purposes. How do you compute it? You know the salary today. After 1 year, what will happen? It will increase by 10%. So that's why you will multiply it by 110%. After second year, it will again increase by 10%. After third year, again 10%. Fourth year, fifth year. So after 5 years, what is going to be the salary? 24 lakhs. Correct? Right? Now, after 5 years, this is the salary which the employee is going to get. Now, this lump sum payment requires last drawn salary, 25% of that amount. Okay. So this lump sum payment means, or this employee benefit or this post-employment benefit, how do you compute it? Take the last drawn salary, take 25% of that. So every year that amount is payable. That will not be paid. That is payable. So multiply that with 5. So that means what is going to be the post-employment benefit? 30 lakhs. Correct? 30 lakhs will be the post-employment benefit. Right? Now, this 30 lakhs is payable after 5 years, not today. Payable means cash payment will not happen today. This will happen after 5 years. But each year, employee will render services. So therefore, an expense will have to be recognized in relation to this. Okay. So therefore, each year, what should be the charge that should go to P&L? 6 lakhs. Yeah. So if you equalize this over 5 years, each year a charge of 6 lakhs will go to P&L. Yes or no? Now, in this case, there's a concept of present value which we need to apply. Let's understand that. How will you apply that concept of present value? Now we understand after 5 years, 30 lakhs will be payable. Correct? Okay. This 30 lakhs is the future value. Yes or no? This 30 lakhs is the future value. So this is 5th year, this is 4th year, this is 3rd year, this is 2nd year, this is 1st year, and we are here today. Okay. Now, every year, what is going to happen? We'll record a charge of 6 lakhs, 6 lakhs here, 6 lakhs here, 6 lakhs here, 6 lakhs here, and then let me just take it out, 30 lakhs, 6 lakhs here. Okay. Now in this case, this charge of 6 lakhs is based on the future value. Yes or no? This charge of 6 lakhs is based on the future value. Rohit is asking, sir, how did you compute 6 lakhs? Simply 30 lakhs divided by 5. 30 lakhs divided by 5. Over a period of 5 years, this cost has to be incurred. So that's why. Okay. Or you can say at the end of 5th year, this 30 lakhs is payable. Okay. So that's the basis we have picked up. Okay. Now, in this case, another point which arises is this 30 lakhs. Okay. So if you look at this 30 lakhs, this is the future value. So can you record the amount in the first year at future value? So if you record 6 lakhs, that is an amortization of future value. So can you record the amount in the books at future value? Tell me, is that correct to record at future value? Will that be correct? Will it be correct to record at future value? The answer is no. Okay, Harshita says it should be recorded at present value. Soumya says it should be recorded at present value. I think Tanisha, Kirti, they have the same answer. So that's why, what should you do? You should compute their present values each year. Yes or no? So each year you should compute the present values. Yeah. So how do you compute the present value? By discounting that? By discounting these amounts? Yes. That's what you'll have to do. For discounting, you need a discount rate and the PV factor. Are you given that PV factor in the question? Yes. So in a way, question has already solved a part for you. Okay, so Nidhi was asking, why is that PV factor given? That's why this PV factor is given. Clear, Nidhi? Yeah? Okay, so now if you apply that PV factor or if you compute the discounted amount, so let's see what are the amounts you are going to get. Okay, so idea was to just make you understand that this discounting has to be done. Okay, so how will you compute the discounted amount? So that calculation is also given. Okay, so each year, what do you do? This first year amount that you will have. First year means end of year 1. So this 6 lakhs you will discount for 4 years. Second year end, you will discount for 3 years. Third year end, you will discount for 2 years. Yeah. So each year, the service cost which you have is what? Present value of the 6 lakhs on the basis of this calculation. Now these amounts will go to P&L. Okay, 4,41,000, 4,76,000. All of these amounts will go to P&L. Correct? Yeah, so this first part is clear. Now, every year when you will record a service cost, Let's suppose at the end of first year, you have this service cost of 4,41,000. Can you tell me the accounting entry you will pass at the end of first year? Over to you quickly. At the end of first year, can you tell me the accounting entry you will pass? Great. Rohan has shared the calculation, which is good. I am asking about the accounting entry. At the end of first year, what is the accounting entry you will pass? Over to you quickly. At the end of first year, can you tell me what is the accounting entry that you will pass? P&L to service cost. What is this accounting entry? I'm not clear. Soumya says P&L debit to liability. Can you please also put the amount in this? Soumya. What about others? Quickly. Ishan, Nidhi, Deepika. Can you tell me the accounting entry that will be passed at the end of first year along with amounts? Devu says P&L to service cost. Can you please think about the accounting entry you're just picking up? See, at the end of first year, what will you do? You will have this discounted amount of 6 lakhs. What's the discounted amount of 6 lakhs at the end of first year? Okay, so this 6 lakhs which you discounted, what did it become? 4.41 lakhs. Yes or no? So at the end of first year, what will you do? You will say current service cost debit 4.41 lakhs to defined benefit obligation 4.41 lakhs. So this goes to P&L, this goes to liability, or you can say the balance sheet. You are speaking up about an accounting entry, current service cost to P&L. So what does it mean? So we are not asking about the entry of transferring it to P&L. Okay, so that's a basic one. Yeah, so this is the accounting entry will pass. Yes or no? Right? Correct? Everyone clear? This is the accounting entry which will be there at the end of first year. Yeah. Now, at the end of first year, you have a liability of 4,41,000. Yes or no? Now, at the end of first year, this liability of 4,41,000 is appearing at present value. Correct? When you have this liability, so this is appearing at present value at the end of first year. Correct? So on this liability which is appearing at present value, in the second year, will you book interest or not? We discussed that on this liability which you record at present value, every year you have to accrue interest. So will you accrue interest or not? Ishan says yes. Soumya, Tanisha, Nidhi, they are saying yes. So how do you accrue interest? Using the interest rate on 4,41,000, can you compute the amount of interest? Over to you quickly. Please calculate and let me know the amount you will get on 4,41,000. If you compute interest, how do you compute it? Tell me quickly. Ishan says 35,280. Right? So that's the interest. Okay. So therefore, your liability will increase by this interest. Now, can you tell me in the second year, Now, in the second year, what is the accounting entry you will pass? Over to you. Quickly. Who will answer this? You need to speak up. Huh? In the second year, what is the accounting entry you will pass? You need to speak up. Who will answer this? In the second year, what is going to be the accounting entry? Yes, Kirti, you will answer this. Ishan saying for interest. No, for everything, Ishan. So can you please explain the accounting entry? You need to speak up. In the second year, yes. Rohan, please go ahead. In the second year, what is going to be the accounting entry? Yes, Rohan, please pick up. Yes, Rohan. What's going to be the accounting entry?
Sir, current service cost account debit 4,76,400
Okay,
to defined benefit obligation 4,76,400.
very
Then
good.
profit and loss account debit to current service cost 4,76,400.
Very good. So this is about the current service cost you will book for second year. Will there be any other accounting entry that will go to P&L in the second year?
Sir,
Just think about it. We just discussed
interest.
interest. Very good. So what is going to be that accounting entry that you will pass in the second year?
Sir, interest account debit to outstanding interest.
Okay. And where do you take this outstanding interest?
Balance sheet.
Balance sheet. Under which head?
Current liability.
Current liability. And that will be DVO. Very good. Yeah. Good. You attempted this. All right. So now let's look at the accounting entry in the second year. Like Rohan just mentioned.
Sir, one doubt was there.
Yes, Rohan.
Sir, 4,76,400 minus 6 lakh will be interest or 8% we have to give?
Okay. So I'll come to your point only now. Right. So in the second year, now what will happen? In the second year, similar to what you did in the first year, every year, this 6 lakhs will have to be discounted. So at the end of first year, when you discounted the value of 6 lakhs, so you discounted that for 4 years. Now, when you will discount the 6 lakhs at the end of second year, so you will now discount this for 3 years, correct? Now, if you discount the 6 lakhs, okay, if you discount this 6 lakhs at the end of second year, what do you get? 4,76,400. That's the amount that you get. So that means for the second year, what is your current service cost? For the second year, what is your current service cost? This 4,76,400 is your current service cost. Okay, so let me just say year to end. Current service cost debit to DBO 4,76,400. Okay, so that's the accounting entry you will pass. Now you may be thinking, but sir, DBO we recorded in the first year also. Yes. So every year you'll have some cost for which you will book a liability. So at the end of second year, one is your liability of 4,41,000. On this liability of 4,41,000 also, you are required to book an interest. For what period? For this period of 1 year. Correct? So therefore, in the second year, you will pass one more entry. interest expense debit, that is 35,280 to DBO, 35,280. So therefore, at the end of second year, what is going to be the total of DBO? You will have to take the total of three items. What are those? 4,41,000 plus 4,76,400 plus 35,280. So can you give me the total? If you take the total of these three, over to you. What is going to be the total? Quickly. So if you add these three, what do you get? Great. Divya is saying 9,52,680. Tanisha and Devu have got the same answer. Okay. Rohan has the same answer. Okay. So this is what you will have to do each year. So every year you will be required to do this. Clear? Everyone clear? Any questions, any doubts if you have on this? Now, please ask me. Yes. If you are clear, very good. But if you have any questions, please let me know. Over to you. Any questions if you have? No? Everyone clear? Sure? Please confirm. Ishan is asking, sir, in the year 3, interest would be on 9,52,680. That's correct. That's correct. Okay, what about others? Any more questions? Everyone clear? Sure. Nidhi, can you please ask your query? Maybe you can just speak up. Huh? You need to just elaborate on your query. Nidhi, please speak up. What's your query? Yes, Nidhi, quickly. Please go ahead. Yes, please explain your query, Nidhi. Yes, Nidhi, please speak up quickly.
सर मेरा क्वेश्चन ये है कि जब कैलकुलेशन कर रहे हैं इंटरेस्ट का तो उसमें क्लोजिंग बैलेंस में सभी को ऐड क्यों कर रहे हैं?
यू आर आस्किंग कि लाइबिलिटी जो हम ला रहे हैं 9,52,680 ये कैसे आ रहा है? Why we are adding all of these? Is it?
Yes.
Okay. Okay. Let's understand. So at the end of first year, Nidhi, what was the amount of outstanding liability?
Sir, 4,41,000.
Okay. At the end of first year, you had 4,41,000. Okay. Now, this 4,41,000 was your liability because there was an expense in the first year. That was again 4,41,000. Correct? Now, in the second year, some more expenditure has been incurred. Can you tell me what is that expenditure?
Sir, interest.
Current service cost. So what is your current service cost in the second year?
Sir, 4,76,400.
Okay. So now in the second year, you have this current service cost of 4,76,400.
400.
Now, because of this additional expense, will your liability increase?
Yes.
See,
Sir.
this 4,41,000 is unpaid. And if you get some more liability, so will you add your liability? Yes or no?
Yes. Yes. Sir.
Okay. So that means to this 4,41,000, you will now add 4,76,400. Is this point clear to you?
Yes, sir.
Okay, very good. Now, one more point. This 4,41,000 at the end of first year was computed at present value. So
Yes,
on this
sir.
4,41,000, in the second year, you will accrue interest. What is the amount of that
Yes,
interest that you will accrue?
sir. 35,280.
So if you accrue interest on this, so will this increase the amount of liability?
Yes, sir.
So therefore, what will you do? You have your opening balance as A. To your opening balance, you will add the additions during the year. What are your additions? That
Sir,
is
4,41,000
and
plus.
35,000.
Yes.
Okay, so that's how you will get your closing balance at the end of second year. So to derive your closing balance at the end of second year, what will you do? Opening balance plus
Plus
any
with
additions
in.
during the year. So that's why you are adding all of this. Clear?
Okay. Clear,
Great.
sir.
Very
Thank
good.
you, sir.
Rohan, yes, please go ahead with your question. Yes, Rohan. Yeah, speak up. Yes, Rohan, please go ahead.
Sir, in first year, 4,41,000 plus the interest amount 35 to 80. It is
Right.
not it is not coming to 6 lakh दोनों को ऐड करने के बाद.
So it will not come to 6 lakhs. Why? Because at the end of first year, when you have discounted 6 lakhs, so you have done the discounting for 6 years. Let's understand this. Okay, so now over here, which 6 lakhs are we looking at? We are looking at this one. Yes or no? Correct, Rohan?
Yes, yes,
Now,
sir.
this 6 lakhs is the amortized portion of this 30 lakhs. Correct?
Yes, sir.
And when are you expecting this 30 lakhs to be paid? At the end of fifth year. Okay. So if you record this 6 lakhs at the end of first year, knowingly that you'll have to pay this at the end of fifth year. So for how many years you will discount it? For how many years you will do the discounting? Tell me.
4 year.
4 years. Okay. So if you discount 6 lakhs over 4 years, that's when you are getting 4,41,000. Correct? That is what you discussed also, right?
Yes, sir.
Now, when you know that 4,41,000 is the present value of 6 lakhs after 4 years. Okay. 4,41,000 is what? Present value of what? Future value equivalent to 6 lakhs, but after how many years? 4 years. Okay. So therefore, to this 4,41,000, if you keep accruing interest for 4 years, that's when you will reach 6 lakhs. After 1 year, you will not reach 6 lakhs. Okay. Clear on this? Rohan, clear on this?
Yes, sir.
Any questions? If you have still remain, please ask me if you are not clear.
Sir, how that 6 lakh, when that 6 lakh will come, in which
Okay.
year?
So let's understand. Now, you have this 4.41 lakhs at the end of first year. Okay. You can just keep computing this, Rohana, and keep telling me the amount. If let's suppose you add interest on this for 1 year, so you get 35,280. Okay.
Yes, sir.
So at the end of second year, can you tell me the amount quickly? What is going to be the amount if you add to this?
Sir, 4,76,280.
Okay, very good. Now, once again to this 476 to 80, you add interest for 1 year and tell me the amount.
So now interest on 476 280 I have to compute now.
Okay, so now at the end of third year, what is going to be your total? If you add the interest to that,
So the interest will be same amount or 8% on 476 280.
no, I'm saying that on this 4,76,280, compute the interest. What is the interest that you'll have for 1 year? Same way, like you computed this interest, compute the interest for next year.
Sir, 38,102 rupees.
Okay, now add this and tell me what is going to be the closing balance.
Sir, 5,14,382.
Okay, now again compute the interest in a same manner.
Sir, 41,150.
Okay, 41,150. Now again tell me the closing balance.
5,55,533.
533. Again compute the interest.
Sir, 44,443.
44,443.
443.
Okay, now tell me the amount. If you add this, what do you get?
Sir, 5,99,956.
Which is equivalent to 6 lakhs. Yes or no?
Yes, sir.
So after how many years did you reach 6 lakhs? 4 years. Correct? Now let's go back to our discussion. So how many years you'll take to reach 6 lakhs?
4
4
years.
years. Understood?
Yes, sir.
So that's how. See, if you have taken 4 years from from the fifth year, you went back 4 years. That's where you get 4.41. So if you have to move ahead, you'll have to move ahead 4 years to reach that 6 lakhs. Clear on this?
Yes, sir.
That's how you'll have to do this. Okay,
Okay, sir.
great. Anyone else? Any more questions? Okay, so I think Nidhi is clear on this. Then I think Richa has a query. Richa is asking, sir, please explain discounting at the rate 8% PV factor, like 8% is given in the question. But what about 0.735? See, if you do the discounting, yeah, so you have to compute the present value. Okay, so the question has already solved this for you. Richa, so the question has already computed this amount for you. Yeah, so that's why you have this 0.735 using this 8%. Then I think Ishan has a query. He's asking, sir, in first year we transferred 4,41,000 current service cost to P&L. So in second year we'll transfer. Yes, that's what you'll do. And each year you'll keep doing this. Okay. Then I think Nidhi is saying in the solution interest is 76,000. Okay, so that's good. Okay, so don't get confused by what we discussed with Rohan. Why? Because that was a very specific conceptual point, not the one related to this specific answer. Because every year the interest that you'll have will not be only 4.41 lakhs. That will be on each year's liability, or you can say each year's accumulated liability. Clear, Nidhi? Yeah. Okay, any more questions if you have? Everyone clear so far? Yes? Okay, very good. All right. So now I think we can take a break. Yeah. So let's take a break and then we'll continue. Manish, we can take a break now. All right. Okay, so I can see few more queries coming up. Just a minute. Let just go to that working only. Okay, so Ishan is asking, so DBO is not paid at the end of each year. So I think it's a question for everyone. So can you please help me with this query that should the DBO be paid at the end of each year? Over to you quickly. Who will answer this quickly? Should the DBO be paid at end of each year? Tanisha says no. In fact, that's why it is called as post-employment benefit. Yes or no? So DBO at the end of each year cannot be paid. That's why it's DBO. Clear, Ishan? Yeah. All right. So now moving further. Now we'll pick up the next one. So there were 4 types of employee benefits we discussed. Okay. So far we have only looked at 2. Short term and post employment. Now let's pick up the third one. Termination benefits. Okay. Now Ishan, I'll come to your queries maybe after this. Okay. Now termination benefits. Now what are termination benefits? Then how are these required to be accounted for? Let's talk about these two. Okay. Now in relation to termination benefits, as the terminology suggests, these are the benefits which are payable at the time of termination. Now what is the meaning of terminating? Let's suppose employees are terminated before retirement. Yeah. Now why an employee may be terminated? Say there was a business segment. One of the business segment of the company has been closed. Say the business segment was running into losses. So the company shut down that business segment. And some of the employees who are working in that business segment, they have been moved to the other one. But some of the employees are not moved. So they will have to quit. Yeah. So that's where you have this termination. So the retirement age is not yet due. So the employees have been terminated before the retirement date. Okay. Or sometimes a company may come up with a scheme. Maybe if the company wants some of the employees to be moved out. So the company may offer the employees to pick up voluntary retirement. Okay. Yeah. So either of these situations could be there. Yeah. Now, the point is this termination benefit requires some conditions to be fulfilled. If those conditions are fulfilled, then any benefit which is payable at the time of termination will have to be payable immediately. Will have to be payable immediately. Yeah. So let's look at those conditions. So now, in relation to termination benefits, standard says couple of things. First of all, this termination benefit got to be approved. Yeah. What is the meaning of approval? Board approval has to be there. So it should not happen that the company is only thinking about it. This has to be clearly demonstrated. So generally, a board approval will be there. Board approval means approval of the board of directors of a company. Okay. So that's one. Okay. So it means it's documented and it's clearly approved. Second, this has to be communicated to the employees and the employees should have accepted this. Yeah, so it should not happen that there's a scheme which the company is coming up, or maybe there's a plan of the company, but that has not been communicated to the employees. Okay, so this arrangement with the employees has to be there. Once you have both of these criteria fulfilled, then you will check, is there any employee benefit which the company plans to offer to the employee? So let's take an example to discuss this. Say there was an employee A. Now A was getting, let's suppose, a compensation salary each year. Okay, let's suppose it was 10 lakhs, then it was 11, then it was 12 lakhs, then 13, 13.5. So this was the salary employee was getting each year. Okay. Somewhere in this year, employee is getting terminated. So the proportionate salary for this year will be paid. So the proportionate salary for this year will be paid. The answer is yes. But over and above the proportionate salary, some more benefits will be payable to the employee. Why? Because now the employee is getting terminated. Let's suppose company says that you will get 3 lakhs. Okay, let's suppose his salary in the year was 14. Okay, so the proportionate salary he will get, but the company is saying that you will also get maybe a one-time compensation of 3 lakhs. Why? Because he is getting terminated. Okay, so now how do you record it? When do you record it? So in this case, the accounting requirement is very simple. This has to be recognized immediately. So what is the accounting entry company will pass? Expense debit to bank or to employee. 3 lakhs, 3 lakhs. Clear on this? Simple one, easy to understand. Yes, over to you. Clear on this, everyone? So this is what we have in terms of termination benefit. Third one. Yeah, everyone clear? Okay, Kirti is clear on this. And again, I think she is clear. Any questions on this, on the termination benefit? No one is clear. Very good. What about others? Everyone clear? Yeah. Great. Soumya is also clear. Ishan is clear. Very good. Now, moving on to the fourth type of employee benefit. Fourth is what? Other long-term employee benefit. Okay, so let's discuss that. Other long-term employee benefit. Now, please remember what is this other? So it's a residual category. Means a benefit which is neither short-term, okay, which is nor post-employment, nor termination. That is what you have as long-term employee benefit. Okay. Now let's take an example of this long-term employee benefit. And of course, how is this required to be accounted for? Charandeep is asking, sir, will there be any present value concept in relation to termination benefit? No. So it's like when the company will come up with this arrangement, so company will know the amount, that's when it will be recorded. As simple as that. Okay. No discounting of any sort, no actuarial valuation. Now, what is the long-term employee benefit? If you remember about short-term employee benefits, so for the financial year 24-25, we discussed anything which is payable within 12 months from the end of the balance sheet date. That is what you call as short-term. Yes or no? Yeah. So this was called as short-term. Now, what is long-term? Any employee benefit which is payable after 12 months from the balance sheet date, which means we are talking about this period. After 12 months from the balance sheet date, that will become your long-term employee benefit. Now, please remember, this long-term employee benefit should be the one excluding post-employment. So you should not mix up post-employment here. Okay. So if there is a post-employment benefit, you will go to post-employment. You will not call it as other long. Other long-term means other than post-employment. So first of all, you will check whether it's a post-employment employee benefit, then you will do that account. If not, then you will come to others. Yeah, clear? Now, a very common example for other long-term employee benefit will generally be the one related to leaves. A very, very common example which will fit this criteria. So if you remember, we discussed about the leave policy. If let's suppose company has a policy of providing 22 leaves, out of which employee has availed 10. Okay, so what is the balance which he'll carry forward? Tell me quickly, what is the balance that he'll carry forward? Over to you. Over to you. What's the balance he'll carry forward? 12. Okay, so let's suppose 12 is carried forward. Next year again, employee will get 22. Let's say next year again, he has availed 10. So what's the balance he'll carry forward? From next year's entitlement, 12. So 12 of this year, 12 of this year, 24 will be carried forward to next year. Means second year. So this 24 will become long-term employment. Clear? Why? Because, sorry, this 12 will become long-term employment. Why? Because this is expected. Let me just change this. This 12, because this is expected to be availed after 12 months from the balance sheet date. So that's why this will become long. Here again, one will have to look at the entitlement, policy of the company, as well as expectation. Similar to what we did in case of short term. And here again, please remember, it has to be accumulating one. Because if that is non-accumulating, that will not come here. Yes or no? Yeah? Everyone clear on this? Quickly, everyone clear on this? Any questions, any doubts if you have, please let me know. Then I think there was one question which we looked at. Okay, let me just go back to that question. And if you remember, there was a detailed answer to that. And that time somebody asked me, sir, this question is quite detailed in terms of the solution, but we have discussed only in a summarized manner. Yeah, so Priyanshi is asking, sir, we did in first lecture. Yes, yes, that's correct. Chirandeep is saying, sir, it should not lapse within. Yes, of course. Yes, of course. Correct. Then I think Rohan has a query. Rohan, can you please elaborate? I'm not clear. Can you please pick up? So, what's your query? Over to you quickly. What's your query? Can you please elaborate? Yes, Yuan, please go ahead with your query. Yes, Rohan. Rohan, please go ahead.
Sir, I was saying that it can be voluntary termination as well as involuntary termination. Voluntary termination, I was meaning that the employee has been terminated voluntarily before reaching his age, and in case of involuntary, he has been removed from the company.
Yes,
So
your
both the
understanding
cases
is
can.
correct. Yes, both the situations are possible. Okay,
Yes, sir.
an employee may be offered a scheme, VRS scheme. In the past years, it used to be very common, particularly in the government organizations. Okay, so employees were given the scheme if they wanted to opt. So they had this option of retirement before their retirement age date. Okay,
Yes, sir.
in
Sir,
relation
here,
to termination, both will get covered.
yes, sir. Sir, here in this leaves example,
Yes,
12 leave will be carry forward now.
yes. 12 of the first year. Okay, so we are talking about this 12 of 24-25. So when you will record the liability for 24-25, so you are expecting that this 12 will not be availed in the next year. So you are expecting this will be availed after 12 months from the balance sheet. So can you record it as short term? Tell me.
No, sir.
No. So therefore you'll have to call it as long term. So you can say it's an extension of the concept that we discussed in the previous session. Yeah.
Okay, sir. Okay, sir.
Okay. Now, how do you record it? So this long term, again, you need to look at the projected unit credit method valuation you need to do. And for this, because it's a future value, correct? So it's required to be recorded at the present value. Okay. Now, I think we can look at one example to discuss this. Just a minute, let us go back. Okay, so let's look at this one. I think this question number 4, this one you can answer now with the understanding of both short term and long term. That time around, I changed this question slightly. Now I think you will be able to understand this better. Whether an entitlement to earned leave which can be carried forward to future periods is a short term employee benefit or a long term employee benefit. Yes, over to you. Please raise hands. I would appreciate if you can just answer this, because in this case you'll have to consider both the aspects, short term and long term. Yes, over to you quickly. Who will answer this? Okay, Ishan will answer this. Very good. Yes. Okay, Priyanshi will answer. Yes, Priyanshi, please go ahead. Yes. Yes, Priyanshi, please go ahead. Please pick up.
Yes, sir. Sir,
Yes.
in question it is given that forward to future periods, which itself is explaining about the few periods in the sense multiple years. So it will be termed as long-term employee benefit, but at the same time we have to see for short-term employee benefit it will be only till the 12 months of 12 months, and more than 12 months it will be long-term.
Okay. So what is your answer? Will you take it to short term or long term?
Sir, if I go as per the wordings of the question, I will go with long-term employee benefit.
Okay. Okay, very good. Sure. So now, Ishan, yes, you wanted to answer this. How will you treat this? Yes, Ishan. Yes, Ishan, please pick up. Ishan, you're there?
Yes, sir. Sir,
Yes,
first of all, though, we will assume that the leaves are accumulating,
right.
and it can be short term and long term depending on whether it is available after that it is accumulating for more than 12 months. If it is accumulating
Okay.
for more than 12 months, then it will be long term, and if it is only for 12 months, then it will be short term.
Okay, but in this case, how will you go about it? Will you call it as short term or long term?
So it's written future period, so I think it will be long term only, but we can give both point of view in this question.
No problem. Thanks, Ishan. Now, Rohan, I think you also have some point on this. Rohan, please go ahead. Yes, Rohan. Yes.
Sir, if the leaves are first assume that leaves are accumulating, and if the leaves are carry forward leaves are availed within 12 months from the uh, end of the balance sheet date, then it will be considered as short term. And if it will be leaves carry forward leave will be availed after 12 months from the end of the balance sheet date, then I will consider it as long term.
Okay, so then I think all of you have answered this very well. Good, huh? That you have tried to attempt this. Now, there's one more aspect. I'll just add to what you have spoken. Okay, and I think you have gone by the wordings of the question, which is again good. But let's also understand this a bit more. So you are saying that because the question says future periods, so that's why you'll want to call it as long term. So that's what I could understand from you. Okay, now let me just help you with the same point. Let's suppose we are in 24-25. Okay, employee has got a quota of 22 leaves. Say these leaves are unavailed, 10 have been availed, and 12 are pending. Now the question arises that these 12 can be carried forward to future periods. So say this is 25, 26, 26, 27, 27, 28. Let's suppose there is no capping. Okay, till retirement, employee can carry this forward. Now, in this case, entity will have to build the expectation. Okay, for two things. That out of these unavailed leaves, what is the portion which will get availed in the next year? Why? Because anything which gets availed in the next year will be called as short term, and anything which goes beyond 12 months, okay, which could be in this year or maybe in any of the subsequent years. What will you call it as? All of these you will call it as long term. Yes or no? All of those you will call it as long term, right? So therefore, in this case, these leaves can become both short term as well as long. So you can't say that this will only become short term or this will only become long term. Of course, these two situations are there. If the company expects these leave to be availed in next 12 months, you will say this is short term. If you say no, all 12 will be carried to 26, 27, 27, 28, then entire 12 will be long term. But if let's suppose management thinks 3 will be availed next year, 9 will be carried forward. So a part will become short term, part will become long term. Okay. So now all the three situations are possible. As of now, we don't know as to what is going to happen. It's more of a theoretical answer. But conceptually, you need to be clear that leave encashment or this leave policy or this any type of benefit may have both the components, short term as well as long. Clear? Okay, clear on this, everyone? Any questions if you have? Okay. So Ishan is asking, it ultimately depends on the company's intention, not the intention, but the expectation. Okay. Then I think Rama is asking, what's the difference between DBO and DBC? See, DBO is defined benefit obligation. I'm not sure where you picked this DBC from. DBC, you need to tell me, where did you pick this from, Rama? Okay, so I think with this, we can just conclude our discussion on employee benefits. And now what we can do is we can just pick up the next topic. A very simple one, quite interesting topic that we have on the provisions, contingent liabilities. Just a minute, let me just get into that document as well. AS 29. Okay, so we'll spend some time today on this AS 29 as well, but I can see some queries coming up. Rama is asking about defined benefit contribution. See, defined benefit contribution means the contribution which is paid during the year in relation to defined benefit plan. Golti is asking, sir, please re-explain the assumptions to be considered while determining short-term and long. See, assumption is very simple. Company will have to check. Company will have to estimate number of leaves or the quantum of employee benefit which is going to be availed within next 12 months from the balance sheet date. Anything which goes within 12 months from the balance sheet date, what do you call it as? Golti Anil, can you tell me? What will you call it as? Anything which goes within 12 months from the balance sheet date, what will you call it as? Quickly, waiting for a response. What will you call it as? Anil, short term? Yeah. And beyond that, it will be long term. Okay. So that's the only assumption. In fact, it's not an assumption, it's an estimate. And please remember, all of these estimates will also be dependent on the policy of the company. So at the first place, what do you check? Policy of the company. Clear, Anil? Yeah. Ishan has a query. Yes, Ishan. Yes, Ishan, please pick up.
Sir,
Yes.
I have a query in illustration 9.
Okay, tell me.
At the end, employee will get 30 lakh rupees, no?
Right,
And DBO we record each year.
right,
So that's why it is current liability.
correct,
And we will record current liability at present value of DBO.
correct.
Yes, sir.
Yes, that's correct. And for DBO, which you will record at present value each year, okay, you will also be accruing interest each year. So
So, sir,
thereby, what will happen? This present value will reach the future value by the end of fifth year or sixth year, whatever be the case in that question.
so we will keep adding the amounts in DBO.
Yes, because it's a DBO is what? DBO is the nomenclature that you use for that liability.
Yes, sir.
Okay, DBO you can say is the term. Clear?
Yes, sir.
DBO is nothing but a liability. And which liability is that? Liability to pay the employee. Okay, for example, you have salary payable. Yes or no?
Yes.
Similarly, you have this DBO, defined benefit obligation. That's the term which the standard has used. Okay,
Yes, sir. Thank you, sir.
sure. Then I think, okay, very good. Anil is clear on this. Very good. Now, moving further on to AS 29. See, this standard is all about two things primarily, though the standard talks about three things: provisions, contingent liabilities, contingent assets. But primarily, it's all about two things: provisions and contingent liabilities. Okay, provisions, you can say, is a kind of liability. So we'll talk about provision also as to what is the meaning of a provision. But over here, in a way, we are talking about the liability. Contingent liability is neither a liability nor a provision. In fact, contingent liability, if you are aware, by chance, it's not recorded. Recorded means you don't recognize it. It's only shown. It's only a disclosure. Yeah. So this standard talks about few things like this. So let's take up some small examples to get on to some of the very basic aspects of this. So during X1, entity has made lower amount of profits. However, to ensure that EPS doesn't decline significantly, entity did not create a provision for warranty. Entity is confident of higher profits in the future years and would like to take this provision to later stage. This ensures consistent performance for the company throughout the year. So basically, this standard requires that if, let's suppose, an entity has incurred some expenditure, okay? Now I'm talking about incurrence, please remember. So should the entity be recording that expenditure? Tell me quickly. If the entity has incurred an expenditure, so should the entity record such an expenditure or not? Over to you. What do you think? Yes? Okay, very good. So can you tell me why should that be recorded? What is the basis? Priyanshi says prudence. Devu says yes, but very good. So it's the accrual concept. Yes or no? Rohan, Devu, they are saying accrual. Somya is saying accrual you need to follow. Correct? Now, sometimes what an entity may do is, entity may not accrue an expenditure by citing various reasons. For example, let's talk about a company. Okay? Say on 31st of March, in case of a company, for the month of March, electricity expenditure, electricity bill which is there, should the entity record this expense? Tell me. Should the entity record this expense? Answer is yes. But a company may have a plea. Let's try to understand. When is this expenditure required to be booked? 31st March. But the company may say that by 31st March, I have not received the invoice. See, the bill is not received. So there is an administrative problem. Yes or no? So how should that be recorded? That's a concern. But in such a case, whether the company has incurred this expenditure? Answer is yes. So if the expenditure is not incurred, then you may not recognize it. But if the expenditure is incurred, then can a company take the plea that how can I book this expense when I do not have the invoice? Answer is no. So therefore, in such a case, the company will have to estimate the amount of such expense and record it. You may be thinking, but sir, how will the company estimate? On the basis of past history. Yeah. And the actual invoice when received may or may not match with the estimate. So the differential can be provided later on, or that can be adjusted later on. Otherwise, what will happen? For the month of March, this entire expenditure will not be recognized. Okay. Similarly, if let's suppose company has got higher profits during a year, and the company thinks that I'll have to pay higher taxes if I show such profits. So what can a company do? company can record excess provision? Yes or no? Yes or no? So if the company will record excess provisions, will the profit go down? Tell me. Will the profit go down? But will that be appropriate on the part of the company? Will that be appropriate? Tanisha says no. That will not be appropriate. Soumya says no. So therefore, to look into all of these things, that any provision, if required, should be created. And if the provisions are getting recognized, they are recognized using some principles, so that there is not overbooking, not underbooking. What do you have? You have the standard AS29. Yeah. So idea is to just give you some background. Now let's look at one more example. AB shops has made huge profits. This may have resulted in payment of taxes on this. So therefore their management foresee that in the future years there will be some challenges. Yeah, profits will be lower. So why don't we create provision in the current year? So if we create the provision in the current year, what will happen? We will reduce the profit, increase the expenditure. And in the future years, when the profit will be lower, what will we do? We will reverse the provision. So therefore our profits will increase. Is that appropriate? Answer is no. So therefore, to look into all of these practices, to take care of all of these challenges, AS29 is required to be considered. Yeah. So now, this standard primarily, as we discussed, deals with provisions, contingent liabilities, and to a certain extent about contingent assets also, which we'll discuss as we move further. Yeah. So now, there are some aspects of this standard which are very important for one to look in. There are some definitions which the standard talks about, which are again very important to be looked in. So the first aspect which the standard talks about is around the meaning of a liability. Okay, so in relation to a liability, there's a definition. Yeah. And that definition requires that there should be a present obligation. There should be a present obligation. Now, what is the meaning of this present obligation? Let's try to understand that. X Limited sells refrigerators with a warranty of 6 months. Warranty means for the next 6 months, if let's suppose there is any problem, so the customer can come to the company and company will service that. Any repair if required, company will do that free of cost. Any part if that is required to be replaced, company will do that. Okay, that is the meaning of warranty. So will there be any cost on the part of the company in such a case? Yes. So the refrigerators would be repaired free of cost if some problem arises during the next 6 months. So in this case, there is a present obligation for X Limited, because if some defect arises, X Limited would need to incur expenses on repair of refrigerator. Understood the meaning of present obligation? That today when the sale has taken place, there is an obligation on the part of the company which has arisen. But you may be thinking, sir, this problem will come in future. Expenditure will be incurred in future. That's correct. But that obligation is arising because of the sale. Yeah, the moment you sell a product, obligation arises. That's why such an obligation is required to be recorded. Let's take one more example to discuss this. Okay, so this is very, very basic aspect which I am discussing only in relation to a liability. Okay, so if you understand the meaning of liability, okay, so these are the aspects you need to look into. Z Limited takes a building on lease for 10 years. Yeah. Lease means it's taken on rent. Yeah. Terms of the contract provide that Z must vacate the building in its original condition. Okay, so that landlord has specified in the contract that when Z will vacate the building, it should be in the same condition. Means after the period is over, after 10 years, it should be in the same condition in which I have given this to the tenant today. Generally, this clause is there in the agreement. Z Limited expects there is a likely cost of rupees 10 lakhs, which Z Limited will have to incur after 10 years so that the building is brought back to its original condition. So in this case, do we have a present obligation? Yes. And when is this obligation arising? The moment Z Limited enters into the contract. Yes or no? The moment Z Limited enters into the contract. Everyone clear? Clear on the meaning of present obligation? Yes or no? Everyone clear? Yeah. So this is more about the understanding of liability. So far, we have not gotten to the concepts of provisions, contingent liabilities. I'm just trying to discuss a very, very basic aspect about the meaning of liability with you. I think Rohan has a query. Yes, Rohan, please go ahead.
Sir, the example that you gave of a refrigerator warranty one, I think that it should not be present obligation. It should be probable obligation because it is not it is not guaranteed that the obligation will arise only. Means defect will arise only in future. It may not arise also. Hello.
Yeah, sure. So I understand Rohan has a query. Yes, Rohan, please go ahead with your query.
Sir, I was saying that the sale that warranty one obligation should be considered as probable obligation and not present obligation because it is not sure that the defect will uh, arise in future. It may or may not be arising. Na?
See, there are two aspects to this, Rohan. To say that this defect may or may not arise, and therefore, should we create a liability or not? That's a matter. As of now, what we are just trying to check is that do we have a present obligation or not? Now, whether that obligation will be probable or not, that is going to be our step number 2. Are you getting it? So, do we have an obligation? Answer is yes. The next question is what is the probability of that obligation? That one will have to find out. Okay.
Okay, sir.
In the example, So you may be thinking, but sir, in the example, they are saying it's written, a provision is required to be made. Okay, so you may have this concern, correct? So you may ignore this point. And that's why I'm telling you that as of now, my intent is what? Just to discuss the understanding that you have
Okay.
in respect of a liability. That for a liability, it has one feature. What is that feature? Present obligation. The moment you say that present obligation results in an outflow which is also probable, that's where you provide it. Otherwise, you don't provide it. Yeah, but we are just discussing, we are just trying to understand the meaning of that present obligation. That's the thought process. Okay.
Yes, sir.
Okay, great. Now, another feature which you find in case of a liability is that it will require outflow of resources, and that is probable. That's the another feature. Now let's talk about it. Because of the past Dell Limited sells laptops with a replacement warranty of 1 year. If something happens to the laptop within 1 year of purchase, company would replace the complete laptop. So in fact, it's not a warranty, it appears to be a guarantee. A few laptops during the past years have been replaced by Dell Limited. In the above situation, Dell Limited would incur some expenses to replace a laptop if something goes wrong. So there is going to be an outflow of resources. Yes or no? So in the future, there will be an outflow of resources. Correct? And why is that outflow of resource going to happen? To settle liability or to settle the obligation that arises by virtue of sale of laptop. Okay, so now there are three features that we are discussing. One, there is a past event which has taken place. That was sale of laptop. That is what you call as past event. Now, because of past event, a present obligation has arisen, or you can say an obligation may arise in future, which may result in outflow of resources. The moment you have these three features, only then you can record a liability, or you can say a liability required to have all three features. Everyone clear on this point? Yes or no? Yeah. So these are the three important features you need to understand. One is past event, second is obligation, third is this obligation will involve outflow of resources. Clear? Everyone clear? Okay, so then I can see one query coming up from Anil. Anil is saying, sir, in case over provision was created unnecessarily and it matches company's past history, then what's the case? Unnecessarily you are booking more expense, which is inappropriate. Yeah. So he's saying, yes, that's where you have the standard in place, which guides you, which provides the guidance that what should become the basis so that such loopholes are plugged. Priyanshi is asking for security only we make a provision so that in future sudden expense should not arise. No, so I won't say it's a kind of security. I would say, okay, security, you are trying to secure the company by booking insurance. You are recording an expense because the company that. Priyanshi, are you clear on this? Yeah. So the company has incurred that cost. That's why it's required to be recognized. Otherwise, it not be recognized. Okay. Clear? Ron is asking, sir, the past events point couldn't be understood. Your voice was not clear. Okay. Now, see the past event in the given example was I see some problem coming up. Let me just try. Just give me a minute. I'm just hoping it's all clear now. Yeah. So the past event in the given case was about sale of laptop. Now, because the laptop has been sold, yeah, that's why you need obligations in the future years. Okay. So what was the past event? Sale of laptop. Clear? Yeah, Manish, I think I'll do this, but we are left with only 5 minutes, so unnecessarily this may create a disconnect. Yeah, yeah, sure. So it's clear now? Okay, great. Okay, no worries. Sure. Moving further, let's look at one more situation. Okay, so let's suppose if we look at situation. So now one was this warranty, which has this period of next few months. Yeah. Next is outflow of resources, which is going to happen in future years, which is going to happen in the future years. So today, what do we need? We need this past event. Okay, which will result into an obligation. And this obligation will require outflow. So you can say it's a flow. It's a flow. Yeah. Or you can say these are the features. Only and only when you have all of these features, that's where you have a liability or a provision. Yeah. So that is one of the aspects you need to consider. Fine. So see, these features or some of these points that we discussed, all of these are going to help us in terms of our discussion related to provisions, in terms of our discussions related to contingent liability, which we plan to do in the next session. So anyways, yeah, so it's going to be a detailed discussion. Idea was to just give you a brief perspective about what all these features are, what all these features are required, or how these features required to be. Okay. So now what we can do is now we'll just move on to your questions and doubts that still remain, and the remaining part we'll to cover in next session. Yes, over to you. Any questions, any doubts that you may have? Let's discuss that. Yes, Rohan. Yes, please go ahead.
Sir, do you have the PDF of module in module 1 in which the financial statements chapter?
You're talking about that age 15 one, or
Sir, financial statements chapter, module 1.
it's a different chapter. So I do not have that handy right now. So if you have any specific query, maybe you can ask me. Okay, but if you want the module to be referred, then I have to pull out that module. Maybe you can just uh, make a note of that point. Let me know. I'll just go through that, and maybe next session I'll just keep that handy with me. As if you want to understand that conceptually, you can ask your query, Rohan.
Sir, sorry, module number 3.
So I'll just keep that handy next time. But as of now, I don't have the module. But what's your query? So do we discuss that without the module, or we should discuss it only when the module is there?
Sir, I'm asking the question.
Yes. So the specific question you can just ask me.
Sir,
Yes, in the
there,
main, yes.
there was one question in which we have to classify the following particulars in the balance sheet under the heads. So you have to tell that under which head it will come as per Schedule 3 of the Companies Act 2013.
Right,
Sir, first is the share application money received in excess of issued share capital.
right. So where did you take it? And what's the query?
Sir, I thought that it will go in share capital account, matlab shareholders fund. Sir,
So
is
where
it
did the solution take it? And what's the query?
sir is it
So if
share
you look at
application?
solution, where was it taken?
Sir, is it share application money pending allotment?
Yeah, that is share application money pending allotment. That's correct.
Okay.
Okay, so as regards share application money or share application money which is pending allotment, so you need to present it separately, and it also requires a disclosure in the financial statements. Okay, for the Schedule 3.
Sir, but in the module, the answer is given that it will go under current liabilities under head current, other current liabilities.
So I think I was discussing something. I think this net is also stable now. So we can continue with the query of Rohan now. So Rohan, just to answer your question, that is required to be presented separately, and there will also be a disclosure around that. Yeah. Okay. Anyone else? Any more questions? Any more questions if you have?
Sir,
Yes, Rohan.
sir, what is a share option outstanding account and where it will be classified in balance sheet?
See, share option outstanding, again, one will have to understand the terminology or the nature of this. It appears that share option is more in the nature of the share-based payment arrangement or something like so, if that is specified over there. And that is again required to be presented separately. Okay, and this will also have a separate disclosure requirement.
Sir, where under which head?
Sorry?
Sir, under which head it will be classified?
See, if it's an outstanding account, so what is the nature they have specified in the question?
Sir, share option outstanding account only written.
So it appears to be more in the nature of a liability share option outstanding, but generally the way the share option outstanding is recorded, it's a kind of reserve which is created. Okay, so you will take it to reserve as a separate line item as share option outstanding. So that's how it's required to be presented. Under the
Yes.
reserved surplus, you have this separate kind of reserve for this type of instrument.
Under shareholder fund.
Yes, so under reserve and surplus, of course, both of them will go to shareholders' funds only.
Yes, sir.
Yeah, but specifically, what is the head in the balance sheet? So that will be the head.
Sir,
Okay.
and what is money received against share warrants?
Sorry,
Money received against share warrant.
money received again. When you talk about any money which is received against the share warrants, one will have to understand the nature of the share warrant. Accordingly, this treatment will have to be given in the financial statement. So, is there anything which is specified in the question in relation to this?
No, sir.
So if nothing is specified, so where did the solution take it? Where have they classified this in the financial statements?
Sir, I think shareholder fund have a separate head for money received against share warrant.
No, no,
Share
I'm saying in
capital.
the balance sheet under which head they have taken this. Shareholder fund is a
Yes, sir.
broad head. Okay, so under shareholder fund you have the share capital, then you have reserves. Okay, then separate line items. So where did they present it in the solution?
Sir, shareholder fund.
Shareholder
Money
fund.
received
Okay,
against
so
share
so
warrant.
that means they have created a separate line item for this. So it appears that once again it's a kind of convertible instrument. Okay, convertible means something which can be converted into share capital in the future. For example, you have convertible preference shares, convertible debentures. So it appears to be of similar nature. That's why they have taken it to that particular line item as a separate presentation. Okay,
Sir, share warrant means.
share warrant is a kind of instrument, and this instrument can be converted into equity at a future date. So that's the kind of instrument which is there. Okay, companies do have these instruments. So you can say companies may issue an instrument which is called as share warrant today. So today it is not share capital, but in the future this can be converted into share capital or will be converted again depending on the terms which are attached to that. So that's how it works.
Yes, sir. Sir,
Yeah.
I could not understand that share option outstanding account why it is going in reserve and surplus.
Okay. So now let's try to understand the nature. See, every time, Rohan, what you need to do is for every line item, you need to understand what is the nature of that arrangement or the nature of that instrument. Now, on the basis of the nomenclature which you have just told me, again, I'll have to get into the module and look into it if any description is available for such instrument. There's a kind of instrument which the companies provide, which are called as for ESOPs. Have you heard about ESOPs?
Yes, sir.
So you can say it's a kind of ESOP. Okay, it's similar to that. If let's suppose ESOP is there, so what do? You create a reserve for that every year.
Yes, sir.
Yeah, so it's a similar sort of instrument you can say which is given. Now, because the nomenclature says it's outstanding, so it appears to be a liability, but because the nature which you are telling me, it appears to be more in the nature of ESOP or share-based payment. That's why I'm saying this. Yeah. But where
Sir,
have they taken this? In the module in the solution, where is
reserves
this
and
presented?
reserves and surplus only.
Yeah, so that means it's the same instrument only. Yeah. Okay.
Sir, whether we have to show it as a deduction in reserves and
No,
surplus?
no, no. So it's not a deduction, it's a positive balance.
Okay.
It must be a positive balance. Please look into it. Is that a positive
Yes.
balance or negative balance? It has to be a positive balance. It cannot be negative balance.
No, sir, nothing has been written about positive or
Correct.
negative.
So that's why it's a positive balance and it will not be a reduction. It will be like any other reserve. Okay. So only thing is you can't mix it up. It will have to be presented as a separate line item. That's the thing
Okay,
you'll have to do.
okay, sir.
Okay. What else?
No, sir.
Okay. Then I think Ishan has a query. Ishan is asking, sir, why are marketable securities having a risk of change in value not considered a cash equivalent? See, I think you have yourself answered this. For a cash equivalent, this risk of change in value cannot be significant. The moment you say there's a risk of change in value, it will not be a cash equivalent. So if you go back to the definition, if you look at the accounting standard, it's one of the requirements. And you have answered this yourself. Okay, Ishan. Then I think Harshita mentioned about that query of Rohan only. Great. So Ishan is clear on this. What about others? Anyone else? Any more questions? Quickly, any more questions if you have? No? All right. So then I'll just request everyone that please make sure that this limited part of AS29 we have discussed today, you revise that. Number one. Number two, on this AS15 also that we have covered. So we are going to pick up few questions around it. So once we are through with these liability based accounting standards, we'll pick up questions on both the topics, on both the standards. Okay. Some small questions will pick up. You'll have to answer this. Yeah. So just make sure that when we meet next, you have revised both these. Yeah. Okay. Any more questions? If you have, please let me know. Otherwise, we can wind up. I see one more query coming from Rohan. Yes, Rohan, please go ahead. Yes,
Sir,
Rohan. Yes.
uncalled liability on share and other partly paid investment. Where
Sorry.
it will uncalled liability on shares and other partly paid investments. Where it will go?
See, again, if there is anything which is in the form of uncalled amount in respect of shares, etc., these all pertain to the share capital. Okay, so that's why within the category of share capital, you have these presentations. Okay, again, depending on if that is uncalled, then you will disclose it over there. So it's more of a disclosure which you will have there, that this much is called. Remember, you have this first of all authorized capital, then you have this issued, then paid up. Okay, then something is called up,
Yes,
something is
yes.
uncalled. So these are the categories that you create. Okay, all will go under the same head. So that's how you present it. In all of these things, again, you are looking at the solution, but just to help you understand practically, schedule 3 requires disclosures to be given. Okay, because if you look at the users of the fancy statements, they are more interested in understanding all of these items, which is possible only when you present them separate. Plus, you disclose, means you explain about them. Disclosure is all about explanation. So that becomes important. So practically, whenever you do these things, just make sure this is how it's done.
Sir, but it is given as contingent liability and commitments.
See, contingent liability, of course, that will be a contingent liability if that is required to be paid by the company. So, are you talking about the money which the company has not called upon, or are you talking about the money which the company has to pay?
Sir, uncalled liability on shares.
No, uncalled liability on shares. So, if let's suppose there is uncalled liability on the shares, so there again two situations are possible. One is in respect of the shares which the company has issued, company has not called upon some money.
Yes, sir.
Okay, so that is not an obligation on the part of the company. Okay, the one that we discussed. Now, if let's suppose there is another company where, so let's suppose there are two companies. Let's suppose now we are talking about A Limited. In the books of A, there's company B. So company B has asked for some money which A has not paid. Understood? B has asked for some money which A has not paid. So therein A will have an obligation to pay that, right?
Yes.
So in such a case, a contingent liability could be there. So you need to understand the arrangement which is involved. So maybe they are just trying to refer to the second situation wherein the money has been called upon, which this company has not paid. So in such a case, company is an investor. Company is not the issuer of the instrument. Fine.
Okay, sir.
All right. Any more questions? No. So we are through. Anyone else? Any more questions? Then we can close our discussion. Yeah. All right. So thanks everyone once again for your time and for this wonderful participation. Yeah. So just make sure that you revise what we covered today. Okay. So thanks so much. Over, Manish. Yes.